Thanks for having me, first of all. My name's Andy Scott, and I'm the Chief Commercial Officer of QCP. QCP, the group, this is essentially solving for digital asset wealth needs across the full spectrum from spot, offboarding, right through to exotic derivatives. I mean, if you step back 5 years, even 10 years, and see where this asset class has come from, I mean, first of all, it's the first new asset class in 400 years. So I think we also always expect a lot from crypto, but really it's grown so fast, so quickly. And so if you think about where volatility was 10 years ago, it was 10x the S&P in terms of the ratio of that volatility, that magnitude. 5 years ago, it was still substantially, meaningfully high single digits. It's closer to like 2 now. In fact, crypto volatility in many respects is effectively where a lot of NASDAQ stocks trade. So it's become much more mainstream. What that means from an institutional perspective is that they can actually put it into portfolios. It doesn't matter how low the allocation is. There's a quality of Sharpe ratio that certain investors need to. And so historically, it wasn't even something they could put in their portfolios. So that's the big change for institutions. They can now use risk management tools because the options markets are growing. Retail investors can start doing more sophisticated structured products, which are essentially just bond replacement yield structures. So that's sort of the two dynamics we're seeing right now. A lot of the institutional growth is obviously now going to come out of the US, and a lot of the private wealth growth still coming out of Asia. So, I mean, I wouldn't say QCP's the best at crypto derivatives, but if I had to guess, I'd say we're probably top one. That was a joke, by the way. So we have been involved in some of the first and some of the largest ever transactions in crypto derivatives. I myself have been in cross-asset derivatives for like 20 years now, sadly. And so we're very much at the forefront of what's taking place there. And what we see happening is a micro market structure that very much reflects equity markets, not effects. In fact, it's a bit of a misnomer that it's called cryptocurrencies, because really besides Bitcoin and stables, everything else is effectively a corporate. So what we envisage is that the likes of the MSCI and Bloomberg will end up having big indices that are passively tracked. They will be rebalanced quarterly. And so hedge funds will start trading rebalance trades. More sophisticated hedge funds, when we get more depth and liquidity across other options and altcoins, will start trading dispersion volatility strategies. And so the argument against that is that Bitcoin dominance is way too high to create an index. Actually, we only need to look as close as Korea and Hong Kong to see that Asian investors have never had an issue with index concentration. Samsung and HSBC were enormous benchmark weights of those countries for years and years and years, and no one had any problem investing in those countries. The MS has actually been really great through our process. I've spent a lot of time consulting with the SFC during their process as well, in a different life. I've been really encouraged by how much Asian regulators want to partner, by how proactive they've been in actually prescribing rules. The reality is it's very hard for them to do it. None of us know how this industry is going to evolve, and that's what's fun. But that's why, for the first time really in history, regulators do rely on industry experts to actually determine the course. So obviously, we would love some sort of global uniformity across regulation in crypto would make it much easier for all of us. We know that's never going to happen. What has changed dramatically in the last week is that President Trump is going to appoint an exceptionally positive, crypto-friendly set of heads of businesses and government, right? And so I think people have really misunderstood or miscalculated how powerful that can be. We can, argue about the morality of it all, but just in terms of pure policy, unemotionally, we can put a new acting commissioner of the SEC in place. We can change the OCC. Banks can have crypto on their balance sheets very quickly. It's the inflection in that is so powerful, because we were nigh on all-time highs. We've been at all-time highs through a Biden administration that was very anti-crypto. So imagine if not only you have that conscriptive holding us back, that constraint, we've actually got now a positive impulse in the regulatory framework. And as much as we want Asia to thrive, Asia is really the center of private wealth in the world. The US is always still the center of institutional capital. It's still 2/3 of investable dollars. And so we have to get the US in a good, safe place to progress forward in any way in this industry. And now I think I'm just so bullish 2025. Yeah, I mean, look, I think they've already made it attractive enough, right? A lot of money wants to come here. A lot of money is sitting here. A lot of that is increasingly going into crypto. What they could do is obviously they could grant more licenses to more credible people. So, obviously, we're one of those firms, but we have many peers who would like to see get regulated too, because crypto is very different to investment banking. When I was at Merrill Lynch or Credit Suisse, I wasn't hosting dinners with my competitors. All right? And crypto is a very friendly industry because we all know if the industry grows, we all do better. It's not about fighting over your share of the pie. It's about dramatically growing the pie. And so I'd like to see more. I already said the MES and the SFC have been pretty collaborative. I'd like to see even more collaboration. And I'd like to see more reputable firms get licenses pretty soon, because that's the best way to tell institutional capital that's now flowing in, this is the place to do business. We understand the native side of the industry. We also understand the institutional side of the industry too. I mean, the one thing there's many things I could talk about. The one thing that I am overwhelmingly excited about is the development of crypto ETFs. And so ETFs is a 40-year industry. And it's not symbolic that BlackRock launched a cash Bitcoin ETF. It's the sheer magnitude of it. This is the biggest launch in history of any ETF ever attempted to be launched. And so what people don't understand is, and I've spent a lot of time with iShares, I've been on their committees in the past thinking about product innovation. When a BlackRock gets behind an idea or a theme like that, it means thousands and thousands of financial advisors around the world are telling all of their clients to get involved in this ETF. So we've got education in crypto scale for the first time in its lifetime. 15 years, it's been pretty isolated. It's been pretty disparate. Now, for the first time, everyone's on board. Regulators are on board. And so that ETF ecosystem was always going to grow and grow and grow. But what is even more interesting now is the SEC begrudgingly have signed off optionality and trading options in the US. The options market in the US is so depth and so liquid that's going to create this whole ecosystem of option strategies in vanilla world that institutions can now trade. But also what we've always seen out of Asia is how much structured product flow will then sit on top of that and reference that asset, because there's no operational uplift in an ETF because it's an equity. And every fund manager whose compliance head at Millennium, at Citadel, or what have you in the past that said, you can't trade crypto, no longer can say because it's in an ETF format. And so I'd say, I'm writing a white paper about this at the moment, so I'm happily send it to your readers and viewers, but I think it's going to be $1 trillion industry. So, and I think people's concern is, well, that takes away from native business. Not at all. They both grow, and they both just become much larger together because there's more comfortability that I can hedge my risk. The view was always that tokenization was going to be the thing that catalyzed institutional growth. It's an absolute nonsense argument. It was always going to be the inverse of tokenization, which is effectively ETFs, bringing native assets into real world investors. And so, I'm super excited by this time.